Hey everyone, we are so excited to be here with Brandon Finazzo. Brandon is with Panacea, and Panacea is a bank that we here at Dentist Advisors use for sending our clients to work with Panacea and have done so for some time and love working with them. We're excited to have Brandon walk us through their model and how their banking model works inside of healthcare and for our dental clients. Brandon, we are so excited to have you with us.
Yes, thanks so much. I'm happy to be here. So I'll give you a little background on Panacea, who we are, where we came from, what we're doing, and hopefully where we'll be going. So Panacea, as you see here, it's banking built for doctors by doctors. So when we say by doctors, we mean that our couple of our co-founders are physicians, practicing physicians, and they founded Panacea because when they were in residency, they ran into a need for some financing, small amount, and had quite some trouble with the large banks because they were in residency and they weren't making the kind of income that doctors, physicians will make once they're out of school and practicing. And so the banks declined them, and they thought this was kind of strange and knew that they were great credits, just didn't have the income at the time. So they created Panacea Financial to assist these fourth year students or residents with some lending, an easy route to get capital to help them with any of the things that life throws at you when you're of that age, moving across the country, buying a house, car, medical bills. Really, it's whatever there is. We want to be there as a crutch to help you instead of you using credit cards. So that's what spurred Panacea and launched us. And since then, we've grown quite a bit, and we've been in a few different outlets such as Forbes, CNBC, Medscape, things like this, and grown to about 4,200 clients since then, which was about almost 3.5 years ago, is when we were founded and started. So we're growing rapidly, and we're in all 50 states. And to give you an idea of what products we have and what's happened since then, the loans I mentioned a second ago is the PRN loans here. That's what we call the small personal loans. So PRN, pro re nata, little play on, stands for on demand, as doctors will use in the medical community. So we like to use some fun play on words, but essentially that's what it is. It's a personal loan up to 75,000 that can be used for anything that you need. It's quick, it's easy, and it's for medical, dental, or veterinary students or residents. After they launched that, they rolled out student loan refinancing, and so we've been doing that for quite some time also. And then shortly thereafter, coming up on 3 years, that's when I joined. We rolled out the Practice Solutions Group, and that what you see there, commercial banking. So it's for anybody who's getting into ownership, wants to buy a practice, become an owner, start a practice, or expand their current operation, however that may be. And I'll dive into kind of the details of those products here in a second. As you notice, it says free checking and high interest rate savings. One of the biggest things we wanted to do with having checking and savings accounts was making it easy to understand and no fees. If you've ever had a checking account, you've probably seen some random $8, $10, $12 fee. You really don't know what it's for. It just is there. And maybe there's some other fees. And I find, and my clients find, that those are annoying. They're hard to track. So we just decided no fees, right? We want to be competitive. We don't want you to, lose sleep over it and have to think, well, how many fees, what are my fees here? So we just got rid of all the fees, which I think is a nice benefit and very simple and easy to understand. So when we say no fees, we mean it. That means wires too, literally no fees. So I don't know a bank that won't charge you to do a wire, but we won't. So that's pretty unique. We, really, really care about our customers and care about the results and how things go. And so I just wanted to share this to give you an idea that, we strive hard to have excellent results and good reviews. And so this is kind of just a testament to us trying to do the right thing and set the right expectation and follow through and be there for these doctors and kind of fulfill the goals Dr. Michael and Dr. Ned had originally sought out to do. So, a little bit of bragging rights here, but we genuinely care. So here's some partners that we have of different associations and groups that we've partnered with since inception. And definitely a huge feat. But just goes to show that, we are doing the right thing and these people agree with what we're doing. And so it's wonderful to have the support of these associations and their members.
Yeah.
When we started the commercial group or the practice solutions group, when I came on, it was very important for us to hire people with a lot of experience from many different backgrounds. And that's exactly what we did. Our front end or sales team, if you will, averages about 15 years in dental finance. And then the credit team that we brought on averages about 16 years. So we have a ton of experience. Our group's new, but the people who work here are not new to this. I came from Wells Fargo previously, and I also worked at US Bank, but we've got many people from TD Bank, Bank of America, PNC, Citi, and UMB. So we really just try to bring, all different walks to help make sure that we're offering the most competitive products. And then, of course, having the credit team with that experience to make sure we're doing the right thing and having a secure portfolio, making the right decisions. So just a review from one of our customers that I thought would be nice to share. So I'm going to dive into kind of the details of what products we offer, maybe something unique about them, why we do them. So refinance loans, probably the most basic and boring of all products. So there's nothing I'd say too unique here, although we're happy to wrap in anything on the balance sheet that was used for business into one loan. If there is a 7A SBA loan that was used for real estate and maybe construction or equipment, that can be broken out into two loans. So one that's primarily for the real estate and another one that's for the practice, as opposed to just having that one SBA loan, which is fairly popular right now because rates are as high as they've been in, I think, 25 years. So we are, getting a lot of requests to refinance, even though rates aren't really low, but the conventional rates are lower than SBA rates, especially the SBA rates that are tied to prime or variable. They shot up pretty good. So refinancing to help with cash flow and lower that to a fixed rate. Acquisition loans. So acquisition loans, means buying a practice. I'd say the most unique thing about us is if a practice is priced high compared to others, I don't want to say it's overpriced because it could be worth that much, right? It's just higher than, than the national average. A lot of lenders look at a percentage of revenues, which we use also, but we can also take a practice appraisal. And if it ends up being, for those of you who know, percentage of revenues, 125% of last year's revenues, but the appraisal says it's worth that because maybe the EBITDA is very high, or there's a lot of brand new equipment, or the margins are great, or the location's phenomenal. Whatever reason the appraisal comes back really high, we can use that appraisal and lend 100% of what that is, even if that means it's 125% of revenues. So that can be helpful for many buyers who are buying some of these practices that are priced higher than others for right reasons. We also separate the amount we lend, meaning there's a value of the practice, then there's a need for working capital, and maybe you're buying the ARs, or maybe you need new equipment. We're going to separate each of those into kind of their own asset, as opposed to bundling them all together and saying we lend max of 90% of revenues, regardless of what the funds are for. Well, that's not how we look at it. We look at it, what's the value of the practice? Okay, we'll lend 100% of that. What's the value of the ARs? Okay, we'll lend 100% of that. Do you need new equipment? Okay, sure. We'll lend 100% of that, right? And then you obviously need working capital, so we'll give you working capital. Obviously, the cash flow needs to work to get all these things, but we're not just going to put an arbitrary limit on how much we're lending based off of a percentage of revenues, right? Some practices have phenomenal cash flow and can cover these things. And if the practice needs them, then we'll do it. So that's one thing that makes us a little more unique. The other thing that makes us unique is we're not scared of huge deals. If it's over $5 million in aggregate exposure, that's fine. We'd love to take a look at it. And then I'm going to touch on real estate, which I'll bring this back to when we get to the real estate. But I'd say that's some of the more unique things about our acquisition loans. Okay, perfect. Yeah, real estate. So again, these are all conventional loans. So the real estate is conventional loan. We do 85% loan to value. This is for an owner-occupied piece of real estate. Owner-occupied has meant 51% or more in occupancy for as long as I've been in banking. But we decided to change that. We think if you occupy the building at all, then it's owner occupied, right? So if you occupy 30% of the building and you have two tenants, Starbucks and some other great tenant, and you're buying that building and your practice is going to house that 30%, or let's say you're buying a practice that's already there, then we're not going to just throw it into investor real estate town. We will still look at it like an owner-occupied loan. And that's important because the terms for owner-occupied are much better than in investor real estate loans. Typically, the length, the amortization is going to be longer, 25 years for owner-occupied. Investors, 15, maybe 20. The fixed term for owner-occupied is going to be longer. Investor, it's generally based on the length of the lease. So that could mean it's only 5 years, which today is not necessarily a bad thing because hopefully rates go down in 5 years, right? But I think the takeaway here is if you don't occupy exactly 51%, don't worry about it. We can make sense of it. So that is definitely a unique part of our real estate. We can get to 100% financing on commercial real estate by financing the down payment with equity in the practice. So that's one way we go about offering 100% financing on commercial real estate.
So nice.
Yeah, not too bad, right? Equipment loans. So we'll do just a straight equipment loan. I think what's unique about this is we'll go 10 years. Generally, you'll see 5, maybe 7, but we'll go as long as 10 years, which can help with cash flow. The approval paperwork up to $250,000 is minimal, so we can get that approved in a day. It's a digital application with a couple documents. Pretty easy process to get approved. But I think the takeaway here is that the length of term is longer than normal.
See.
Partner buy-in loans, buyout loans. I'm going to go into this one in a lot of detail, so I'm just going to kind of put that there for now. But this is a unique product. Startup loans. So where do I begin here? So we do startup loans, and I think we do a very good job of them. When I joined construction costs had just started to go up, and we recognized that, I'd say historically construction wasn't, too bad. You'd find places where it was $100 a foot, right? That would be impossible to find right now, I believe. And you can actually find construction as high as $325 a foot, unfortunately, in some of these bigger cities, Seattle, Boston. So I say that because when we rolled this out, we wanted to make sure that we were offering a loan that fit the market, right? We didn't want to say, okay, we'll do a startup loan up to 500,000, and that's it. I don't think you could start a practice and build out a practice, over 1,200 square feet for 500 grand, including equipment right now. So when we did that, we increased the amount that we can lend. We look at each borrower individually and each project individually and the locations individually to make sense of it. And what does that mean? That means if somebody came to me and they were in a very expensive area and the whole project with equipment and everything was 900 grand, and this is a very strong borrower, then we can do that deal. If the same size square footage came to us in an area that was not as expensive to build and it was 700,000 and the borrower was great too, we could do that deal too. But what we're not going to do is say we max at 700 or 800 because that's our guideline. We're not going to just put a cap there. We obviously have policy and we have guidelines that we need to stay within, but if we have a very strong doctor, then we will make the case and lend a little bit more, if they qualify. So, my point is it's common sense lending here. We want to make sense of each deal. We want to look at everybody individually, and see if it makes sense. I've done a couple pretty large startups that had multiple doctors that were around 1.5 million on the lease space. I'm not trying to advertise that to tell people to apply for 1.5 million, because the goal is to get as small as a loan as possible, guys. Okay, don't misunderstand me. I'm just saying if there is a big project, we can handle it. And keep in mind, these borrowers were very, very strong, out of school a long time, tons of savings, all these things. But we can do the little stuff and we can do the big stuff is where I'm going. When we do a startup loan, if somebody wants to buy the real estate, historically, this was really tough. Where I came from, that wasn't happening. That was going to be an SBA loan. We can entertain doing a real estate loan and a practice startup loan simultaneously. Again, both conventional. So that's very, very, very competitive. Still need to come with some money down, but it should beat out SBA pricing and SBA fees if you can qualify. So we are able to help doctors buy real estate, right out the gate if they qualify. So I'd say our startup loans are fairly aggressive compared to what's out there. But the borrowers that want those large, harder loans to get need to be, just as strong. So that's a little bit on our startup loans here.
That's a great overview so far.
Yeah. The construction development loans. So, with startups, you need to do construction. So kind of covered that a little bit, but what other loans could have construction in them? Well, let's say you have your practice, you bought it 5 years ago, and you've really never liked the layout, the carpet, the paint, anything for a long time, and you're ready to remodel it because you're doing so well. Perfect. We'll come in there, give you $300,000, $400,000, $500,000, and you can renovate it and make it look exactly how you'd like. Or if you're really, knocking it out of the park and you see some land you like and you'd like to build your own building, fantastic, let's do it. So we will do what we call a ground up construction loan, help you erect that building, build it out. So from start to finish, it'll be one loan. We use an as complete appraisal so that we have an accurate estimate of the value of that building. Therefore, most of the loan will be on the real estate loan. And then if there's excess, we can put it on the practice. But but these ground ups have historically been SBA. I'd say 75–90% of people who are doing a ground up still go SBA. Probably haven't heard that we're doing them. It is fairly new. I don't know if other banks are, but that's just how it's been, because they're tough loans. When you're building a building, a lot can go wrong, and if you don't have extra cash laying around, this can be very detrimental. That's why historically banks haven't done them conventionally, because they're pretty risky. But we can help with those for the right customer. Other construction loans is just relocating your practice and building out. Anything that has to do with leasehold improvements or building a building, we can help with. We have a dedicated in-house construction team. This is very important. Is the same credit group and team working with the same people that are funding your construction loan? You want one team, because if there's a mess on the construction side and you need more money, or you need to reallocate funds, or whatever's happened, because something's going to happen, credit's going to get involved and they have to approve things. And if there's two different groups and divisions that don't work together regularly, this can be time consuming. It can be a pain. Our group all works cohesively together. Everybody under the Panacea roof does all of this. So when our customers have construction issues or delays, or they need more money, they can easily reach out to our credit group. We talk about it. We knock out an answer in half a day. So that is something that's not really talked about a lot, right? Everyone's like, well, what's your rate, right? What's your rate in term? Okay, I want to work with you. Well, on the backside of that, after you get your great rate, how does the process go? Are you going to have a team that's phenomenal at doing this? So just something to think about, when you're looking at all these different lenders. And that's one of the reasons we made certain we were going to have an in-house construction team. You also want them to understand how inspections work, title bring downs, all the little nuances that go with funding a very large construction loan, understanding what type of contract you should have. Is it an AIA contract, fixed price, all these little things that you want to pay attention to. So we have that in-house. And so, yeah, we do construction loans pretty well. Working capital loans. These are few and far between, but if your practice, needs a cash injection, maybe you're hiring a couple of doctors and doing a marketing plan, and you just don't want to, blow through all your savings. Okay, then that makes sense. We can give you a couple $100,000 for some signing bonuses and a marketing plan, and off you go. Typically, we'll do these in term debt as opposed to a line of credit. Most dental practices don't need a line of credit because they turn fast enough that they're not really carrying too much of the overhead while they wait for the AARs to come in. But in some circumstances that you may need that. With the United Change healthcare issue that happened, a lot of practices weren't getting paid because of the cyber attack. It's a perfect example of when you need a quick, cash injection. Maybe it's a 3-year loan just for a crutch until United Change gets their act together, fixes it, and pays you for the work you did, and then you can pay the loan off. But that's something where we can come in quickly and help when unforeseen issue arises and you need cash. So we have working capital loans to help too. Expansion loans, I think I covered that. I think the biggest takeaway here is when you're buying a building and you're moving your practice into it and you need to build it out, you want your lender to do an as complete appraisal, not an as is. Because if they do an as is, the value is going to be a lot lower, meaning the real estate loan will be a lot lower. If they do an as complete, you can put more debt on that real estate loan, which means your overall cash flow will be a lot better. So when you're buying a building and build it out, tell the lender, I want an as complete appraisal. If they don't want to do it, call somebody else who would like to, okay? Because it's going to help you tremendously. It's also the right thing to do because the debt is for the real estate that you're building, right? That's where it should be. And your CPA would probably agree with me, so run it by them too. Deposit products, treasury management products. We talked about the free checking. Again, that's what that is. We also decided to increase our business savings to 3%. You'll probably see a lot of consumer savings with a high rate, like ours is 5%. Other banks have high consumer savings, but business savings, it's a little tougher to find a bank that'll pay you on the business side. So if you've got a lot that you keep in your business account and you're not, distributing it to yourself, and you want to keep in the business savings, this is a good account for you. But check that out. And then treasury management products, again, free. So we're going to give you the machine. We're not going to charge you. And then every time you scan, if you did 1,000 a day, we're not going to charge you. ACH wire, not going to charge you. So free banking truly is. So those are our products.
Man,
And now, yeah, what was that?
yeah, I just said that's solid.
Perfect. A good time for me to get a drink here. So like I said earlier, I wanted to touch on this partner buy-in loan that I love, that I think is very unique. The reason it's unique is because if you're buying 25% or 20% into a practice, or maybe you work at a massive DSO and they're allowing you to buy in, we can do that loan without asking for a lien on that practice, which is fairly rare. So rather than taking equity out of your home or depleting your savings, we can give you a business loan that's unsecured to help you buy into that practice. So that's what's really unique about it. Obviously, it's quick 48-hour review times, 3, 5, or 7-year terms. We go up to 400,000, and that's kind of the basic product that will get done quickly. We do get requests that are above 400,000, and again, we are not the bank to just turn you away because of it went over 400,000. So we will look at it, see if we can help. We've done this on a 10-year note for $1 million for a really strong client. So we can handle larger loans too on this, but it's really unique. I think this is more common than not with the amount of DSOs that are growing and offering ownership. People who maybe want to get the benefit of the profit sharing, but don't necessarily want to deal with hiring and firing employees, may buy 10%, 20% into a practice. And so these loans can help you get that.
Yeah.
That's all I got for you today. Appreciate you having me on with you.
Yeah, so good, Brandon. Thanks for giving us the full walkthrough. And we can say from the Dentist Advisors side of the house that the Panacea has been great to work with, and we're excited to work with them and continue to work with them and refer to them. We're going to be doing more content with Brandon. You'll see it as we as here on this Facebook Live, and some of our upcoming webinars and content and such. So feel free to poke around on dentistadvisors.com and get to know Brandon and his team. Feel free to touch base with our advisors. Our advisors are talking about this, as you know, on the regular, and therefore have a really good sense of what you are going through inside your practice. And so Brandon, thank you so much for your time.
Yeah, my pleasure. Appreciate you having me.